Support for the show comes from Capital.com. Capital.com is an investment platform that aims to accelerate financial inclusion globally. For seasoned traders, Capital.com provides 24-hour support in over 10 languages, competitive, transparent pricing, access to news and resources and analysis to help you make a more informed decision. If you've never traded before, Capital.com's education hub includes in-depth courses to help you get started. For more information, check out capital.com.
So, to me, are VCs responsible? I think in general, capital was so cheap, right? Founders realized that capital was cheap, so they were going aggressive. Capital was cheap somewhat for VCs as well, so even they may be going aggressive. And our business is about the power law. You got to be in the winners, and it's very hard to know at the time of investment which company is the power law company. So you don't want to miss something that has momentum. So yes, some mistakes were made, but I wouldn't. I mean, I think it's a little bit early. I think the vintage will be overall not a great vintage because you paid high prices, but there'll be a difference in how funds have done even within that based on the quality of what they put.
Hi, everyone, and welcome to Conversations with Loulou. My guest is GV Ravishankar. He is the managing director at Peak 15, previously Sequoia India. GV manages growth investments at Sequoia. This is the $20 million plus check. And he sits on the board of startups like Tabi, Huspi, and Lean Technologies, and several other Southeast Asia and India-based startups. We will be talking about the state of the growth investing and GV's take on the MENA market region. Thanks for coming, GV.
Thank you, Lulu, for having me on the show. Appreciate it.
Well, it's, I was passing through Jitex yesterday and I saw a really big Peak 15 space.
Yeah,
I think you're really working hard on building the brand. I know you personally moved to the UAE about 3 years ago,
2.5 now. Yeah.
2.5 years ago. So can you maybe tell us a little bit about that shift from Sequoia India to Peak 15 and what does it mean to be building this new brand?
Yeah. First, thank you for the question. And yes, we have a little bit of a space in Jitex Expand North Star, and where we are using to meet founders and kind of educate them about what we're looking for and understand their ideas and what they're building. So just on the Sequoia Peak 15 thing, look, we've been Sequoia in India has been around now 17 plus years, and June of this year we decided to all separate out to create our own independent franchises, and so we became Peak 15. Our China partners became Hongshan, and US remains Sequoia. And it was a well-considered decision. We've been, I'd like to say it the following way: we entered the 18th year. We are now adults, and we can stand on our own feet. So it's a little bit of saying, hey, we've all become large and sufficiently large to manage ourselves and market leaders in our own markets. And now it's time for us to, have independent identities and move on. So that was the thought process. It's been a very smooth transition. We are now about 4 months into this, and founders have taken it well. LPs overall seem to continue to be very strongly supportive, and on a day-to-day basis, nothing changed. And people ask me what's changed. I tell them, I got new jackets, new T-shirts. So outside of that, nothing much has changed. But we are excited as a team because it's a chance to build a firm out of the region for the world someday, and a chance to be independent and build something that can be an enduring franchise over a period of time. So very inspired by what Sequoia's taught us. We still have very, very fond memories. We are very grateful to our partners, Doug, Mike, and others who set us up. And so now it's on our shoulders to take this forward.
Yeah. Can you maybe give the audience a little bit of a background of the investments that you've done, the
Sure.
check sizes, like what you've done in the past 17 or
Yeah.
18 years up to this
Sure,
point?
happy to do that. So just as a stepping back, we managed roughly about $10 billion for the region. Our region is India, which is where we started, Southeast Asia, where we went to second, and now MENA in the last couple of years. We have 13 funds under management, and the most recent set of funds were raised last year, totaling up to about 2.85 billion across 3 funds. One is a India Venture Fund, there's an India Growth Fund, and then a Southeast Asia Focus Fund. Between these 3 funds, we raised last year. It's about 2.85 billion under management. Our strategies are everything from very early stage through a program called Surge, which is like a programmatic, model of investing. We have cohorts of companies that get together, and we help them over a 10 to 15 week period where we help them go through a bunch of company building learnings along with a bunch of special founders that come and talk to them and others from the inside who kind of handhold them through that journey. And we do 2 batches a year typically. That's Surge, and my partner Rajan Anandan runs that portion of the business. And there we write anywhere between 1 million and 3 million in early stage, very early stage companies. And it's an open kind of a platform. Other people can co-invest with us in those in that program. So we have routinely have several venture funds co-invest with us in that. So that's the earliest part of what we do. Then there's a venture business which my partner Mohit runs. That business, we typically write Series A's. In our part of the world, Series A's are $5 to $10 million. So that's really how we think about that business. And then the growth business starts at 15 to 20 million and above. That's the business I manage, which we look to invest in Series B's and beyond, and all the way up to pre-IPO companies. And very selectively, we have the from a mandate perspective, we can invest in public companies, but mostly we stick to private companies, unless there are some serious dislocations or companies we really know which we want to back in the public markets. And the Southeast Asia business is focused on that region. All our Middle East investments come from the India pocket. So in that sense, it's one pocket for Middle East and India. In the Middle East, like you rightly pointed out, I've been here last couple of years plus, and honestly, it didn't happen very top down saying, okay, what's the next market we want to go to? It just happened, it's just serendipity. Like I was here on a small break with my family, April of 21, and I couldn't fly back because the air corridor got shut. So what was supposed to be 2 weeks became 2 months, and in that, now it's 2.5 years. And while we were here and we decided to kind of stay and continue for my son's schooling reasons and so on, we started meeting companies in the region, and what we saw was a very similar pattern to what we had already seen in India and then in Southeast Asia, where there is a bunch of customers who are starting to adopt technology in a very significant way, thanks to mobile internet, and so on and so forth. And every sector was starting to see technology penetration. So when that happens, we find that there are many industries that get disrupted by technology-enabled solutions, and that creates market cap, whether it's food delivery, ride hailing, e-commerce, and so on and so forth. So we've seen the same pattern play out in India, Southeast Asia, and here. So when we met the set of founders we said, okay, these things we have seen. So it's starting to happen in this region. Maybe this region is 5-7 years behind in some areas, maybe 1 or 2 years behind in some other areas. And so how do we use the same pattern recognition that we have had, where we understand some things will happen, and if we find really good quality founders going behind those opportunities, why should we not be a part of their journeys? And that's how it got triggered that we would make investments. So we now have 4 investments in the region. So there's Lean, Tabby, Husky, and Foodix.
Okay.
And so far very happy with how things have progressed, and we continue to keep looking for those special entrepreneurs who are building these great companies and enduring franchises.
Okay, just before I want to talk to you about the market and the companies you've invested in, but just before we go that a little bit on the brand side, on the Peak 15 side, do you see it becoming more challenging to compete potentially with the big VCs that typically invest in growth stage? Do you feel that this could be?
No, it's a great question. The biggest challenge was to find a name, to be honest.
Okay.
What you realize when you have to find a name for an investing firm is that it's a very low entry barrier business. Any name you can think of is taken, right? So we thought the biggest challenge was that, but honestly, just on a more serious note, look, our business is a people business, right? So when we spoke to our LPs and this whole conversation saying, hey, you're not Sequoia, what's going to happen, came up, we spoke to them about this concept of an earned brand, right? So there is a brand that's given to you. Like in our case, we had Sequoia as a brand, which we had inherited for the region. And we were Sequoia, and we were building Sequoia for the region. But there was also an earned brand, which is a reputation you earn by being in the market for a long period of time.
The partners'
as
reputation.
partners, but also as a group of people that are working together for such a long time. I mean, I told you 3 of us as partners joined in early 2006. So we've been doing this for now 17.5 years. And so you have your networks, you have your founders, and not just us, but many more partners in our, like we have 12 managing directors in our firm. And on an average, each of them have spent more than 10 years in the firm, right? So, the collective networks, the collective knowledge, the collective, founder relationships that they have together makes this a very powerful, earned brand and earned reputation. So what we found is that a founder who's referring you to another founder is not doing that because you were called X or Y or Z, but it was because of the impact you and the organization have had, the group of people have had on them in their journey to building an enduring franchise. So if they like what we have done for them, if they've found value in the relationship, they will go and refer us to other people, right? And so that positive word of mouth and that is continuing to be very strong for us. And we're just grateful that we've had the time and the lineage to be able to do that. Have had a reasonable track record in the region to say that there are enough people that are supporters and believers that would recommend us to other founders who are starting up today. So yeah, so that's the concept of earned brand, and we think that's working well so far. But that is not to say we should rest on our laurels. This is a tomorrow's business. It's not yesterday's business. So we got to constantly keep doing what we do really well, and we're very committed to doing that.
Yeah, absolutely. I mean, especially I think in the area where you are most active in, which is that growth stage area, where typically I would assume that a lot of startups in this part of the world and probably in India would want to go to the US and
Sure.
seek additional funding there.
Yeah.
So I would imagine that.
Yeah. So I think one thing that is working really well is look, founders also appreciate that the days of I'm the Uber, I'm the Amazon of this market. Those kinds of things are, you quickly run out of those themes. Then you have to solve for your own markets, right? And then when you solve for those markets, the understanding that people who are in the market, from the market, can have for the problem statement that you're going behind can be way better than somebody sitting somewhere else who's kind of doing pattern matching at the highest level. Now, pattern matching is very valuable, and we have done that across markets ourselves. But that maybe contributes for 20-30% of what you do. But a lot of the businesses that will get built in the region, whether it's Middle East, India, will solve very domestic problems and opportunities in that market. Just to give you an example, if you take India, India's going through this whole consumerism as a wave, right? And because people are coming from middle class to upper middle class, and the consumption patterns are changing, the amount their earning is going up as the per capita GDP is going up, and the amount they are spending on discretionary items is going up. So we're going through this wave where in the last 10-15 years, a lot of people are buying brands for the first time. So the market is moving from unorganized, unbranded to branded and organized, right? This is a theme that must have played out in the US, like, I don't know, 50 years ago or something.
Yes.
So if you are sitting in the valley and looking at a direct-to-consumer D2C business or a brand business in India, you would not understand why this is so exciting. It's not exciting. But brand is one huge moat and a value creation lever that companies in India use, especially as they build it out in this current markets. We are seeing a lot of companies come in the whole direct-to-consumer space, brands that are built online first. I'd like to think of them as online first brands, eventually that become multi-channel, omni-channel. So that's a theme that's, I wouldn't say unique, but definitely more relevant for a market which is under-branded, right? Let's come here, right? Like there would be uniquely, problems that you can solve for this region. For example, if it's fintech or, where like a good example is Tabby, credit card penetration is very low in Saudi, right? And that's why the whole buy now, pay later model as a payment option at checkout is actually a very significant opportunity, and they've done really, really well. And so you will find market to market there are nuances, and it's not easy to understand. Yes, buy now, pay later is a global theme, but the reasons why it works in some market is very different from why it works in other markets. And at least it was very clear to us as we were doing the diligence and understanding the market, that there's a reason why this company will be very successful. Not just that, buy now, pay later in this geography has the best metrics anywhere in the world, right? And that's not obvious sitting outside, when you look at the market. So I think these are some things that, people, local growth funds would actually have better appreciation for, and which case the founder also feels like, look, you get them, and then you can be a better partner than somebody who's just applying themselves with the same lens as Western markets, which may not always be the right thing.
So you mentioned an interesting word, which is pattern matching. I like that word. So what kind of again, you kind of touched a little bit on the parallels between India, Southeast Asia, and the Middle East now. But could you elaborate maybe a little bit
Sure.
more on what you are seeing? Why you are personally excited about this part of the world?
Yeah. So the one big difference between India, Southeast Asia, and Middle East is just purchasing power, right?
I mean, and size of market, right?
Yeah. Well, size of market, you're right. On an absolute basis, we have 1,400,000,000 people, so 1.4 billion
1.4.
almost, right? So that's coming from India. And then, you come here, you have maybe roughly 60 million, the whole of GCC maybe. And then, if you include Egypt, it's a little larger. Now, it's one way to think about it. Yes, you don't have the same number of people, but you have substantially higher purchasing power, right? So when you're talking about Saudi, maybe it's 25, 30,000 GDP per capita. Maybe in the UAE, it's higher. In India, we're talking about $2,500 GDP per capita. So for every one person in India, like the spends are 10x in Saudi, roughly speaking, right? So if that's the case, then your 35 million people is probably like 300 million people, 350
Yeah.
million people. Maybe I'm just giving rough
Yes.
metrics. So we got to start thinking about it as saying, what does that mean? And what it means for businesses is that while you may not have the scale of what you can build in India, you could have the profit pools that could be quite interesting, right? And so I keep telling people that there may be a few ways this market works out, right? One is that you have, the profit pools are significant, so you may have slightly smaller in end state, slower growth companies, but very profitable companies, right? So that could be one way to answer. Second, I think for various reasons, including the fact that not a lot of growth capital is available in the market, there could be more concentrated winners in this region, which means you're not going to have 5 people compete for buy now, pay later, 5 people compete for horizontal e-commerce, 5 people compete for ride hailing. It may be down to 2 people, right? And I mean, even globally, some businesses, network effect businesses, end up being 2 people. But I'm saying even across other markets, which are not winner take all or winner take most markets, you could still see high concentration of winners because you don't have a lot of capital to back 3 or 4 or 5
Well, we
companies.
don't. I mean, we don't have into venture capital anyway.
Exactly. So it's early days. And what that means is if you're a winner, capital could get concentrated into those few winners, maybe 1 or 2. And that allows you to have a higher share of the market because you're not competing with 3 more funded or 4 more funded competitors. So if it plays out that way, you have let's say $100 market, of which in a typical market, if there are 3 or 4 competitors, maybe people get 20, 30% each. You could get 60% of the market. Now the market size may be 1/5 of India in that particular segment, but if you can get 2x market share, so at least you get somewhat, it'll not be equal. You may not be able to build equal sized businesses. But if you think about GCC as a starting point and then eventually MENA as you expand, maybe you can build half the size of an Indian company. In fact, Tabby is probably larger than any other buy now, pay later company in India today. Even though buy now, pay later started happening in India earlier than this thing. And for, again, variety of reasons, one of which is the industry structure here, credit card penetration here, and the MDRs here, etc., allow for you to charge what you charge and hence, build a business of scale. So I think it is industry specific. And in some industries, you may be surprisingly be able to build large businesses in the region, given the average order values, ticket size, and GDP per capita, right? So again, one of the things I look at is I look at the market and see where's the market cap, right? Like if you look at Saudi and look at financial services banking, there are $200 billion market cap companies. Now that's not small. If you could build a fintech company at $10 billion, all of us will feel like we built something fairly valuable from the region. So I think there's an opportunity because the profit pools exist. There are examples of large companies. It's the banks today, but all fintechs are somewhat trying to get some part of that market cap for themselves. So if somebody is successful and is innovative, is nimble, is able to get the right kind of backing and support to go behind some of these profit pools, I think there's a chance to build a $10 billion company. I hope Tabby becomes one and maybe hopefully many more to follow.
And you seem to have, anyway, a focus on fintech. I mean, the companies you've invested in, they all have a fintech play.
100%, yeah.
So is that is that the gap that you see in this particular market?
Yeah, I think, when we came in and we met companies, there were a few things that stood out for us. This consumer internet, in terms of commerce, that seemed like a large market opportunity, and then financial services and fintech seemed like a large market opportunity. Now, our strength, going by at least what we have done in India, Southeast Asia, is, financial services and fintech is a market we understand. For a long time, we've invested both in offline traditional financial services as well as all the emerging fintech, whether it's payments, whether it's lending, and so on across the board. And it's something that we understand really well. We've seen those stories play before, and we've always over-indexed on that. And part of this is, again, where market cap in India has gotten created. So if you look at the public pool and see, profit pools where they exist, about 30, 35%, or maybe 40% of the profit pools are in financial services, and maybe 35% of the market cap of the top, Sensex 50 or whatever, like the 50 top stocks, again, is in financial services. So we know it's a very large market opportunity, and it's true for every market, right? And every market will have its nuances. But especially because it's regulated, you don't generally have a lot of disruptors easily coming in, right? And so when you look at the market structure, there'll be a few banks which are large, and then the next set of banks, and then not many other companies that would be large. And if a fintech company comes and it's kind of breaking through some of the shackles of what is not done before and gets the consumer reach, and consumers find a value prop in their offering, then they have a chance to become the next big thing, right? And so our thesis was, look, fintech should be interesting in the region. Consumer broadly should be interesting, consumer internet, commerce, etc. But honestly,
Such as?
that's well, you start with horizontal commerce. You could argue
Such as?
compared like Amazon or like what we have here, Souk.com, which got
Okay.
acquired, and then Namshi and others. But the point being, these also are big themes, but these are large dollar plays, right? You cannot play with 10, 15, 20 million dollars. You got to keep raising hundreds of millions of dollars to establish yourselves to become somebody, and that is not always a play for people like us. And it's not a play where you could sign up and say, I will do this without visibility for any other support capital downstream. And that is a challenge. Right? So if you have to sign up for hundreds of millions of dollars, either you should be willing to write it yourselves, or you should find like-minded people who believe in the theme. And yeah, for those reasons, maybe horizontal commerce is not necessarily for us. But even there, you look at what's happening with the incoming Chinese commerce companies. They are like really, really doing well. At least from what I hear, they are taking off significantly.
Like Shane.
Shein is very popular.
Yes.
Then we have Temu, which has entered, TikTok commerce, and I believe Shopee commerce is entering, etc. So some of these are showing that, look, if you deliver strong value prop to the consumer, I think people are going to buy. They don't care necessarily whether it's a domestic platform, global platform, where it's coming from. If you drive value for them. So commerce is about convenience, choice, and pricing or cost, right? So kind of as long as those parameters work out and you give them great products at affordable prices, and get them conveniently, people are going to order. So I think those are opportunities, but I don't know whether necessarily those opportunities will be opportunities which will be taken advantage of by the Middle East companies. The reason being, generally we don't have strong manufacturing supply chains in the region, right? Maybe there is some in Egypt, but you don't have that in our geographies, and I mean for good reasons, because labor and some of that is hard. So China has that, and some South Asian countries have that. So you're likely to see companies from there using their strong supply chains to actually try and dominate these markets, right? So it's not necessarily for us, hence, because it's, but there may be derivatives of that, like whether it's logistics, whether it's payment systems, etc., which could be interesting for us, right? So as commerce develops and more solutions are needed for delivering a great experience, some of that could be opportunities for local companies and founders.
Okay, so fintech, you see the gap. Commerce, not necessarily, because you need
Well, there may
very,
be,
very deep
yeah,
pockets.
maybe variants from commerce or offshoots of what commerce
So-
enablers are that could be interesting. For example, I mean, there are good companies in Saudi that are enabling small merchants like Shopify type platforms that have come.
Yes.
And they understand the nuances of the Saudi entrepreneur, small entrepreneur and SME
Yes.
businesses. And they're enabling discovery of logistics for them, payment systems, and creating this very simple to use products, and of course Arabic language support, which is very important. So by doing all of that, they've created some momentum, right? So I think those are good examples of, as commerce takes off, there will be enabling things that will have to come up in the ecosystem, which could be interesting opportunities for us.
Yeah, I mean, I see some of it on the B2B side, right? Like we've invested as Spade Ventures into a B2B,
Yeah.
For example, marketplace for Horeca.
Yeah.
I think there's these maybe
Correct.
types of
Correct.
plays. But apart from, I mean, are there other kind of, I mean, do you look at industries like, I don't know, clean tech, or I mean, what are some other industries that you look at apart
So
from?
clean tech in this region we have not looked at. We have a bunch of investments in India, particularly through the Surge program, where we have done some early stage, made some early stage investments in clean tech. It's a theme that some of us in the firm are interested in and we follow. We haven't really met a lot of companies in that theme in this region. Maybe it's just not something that we are focused on. And we were kind of starting with the biggest pockets of opportunities and focused on those. But it's something we'd be open-minded. Look, this region, of course, kind of oil-rich, and there's a lot of initiative I'm seeing from the government to try and push more clean energy sources and so on.
Yes,
So
and you have
hopefully we have COP28
this
coming.
year,
So
and
hopefully
next month.
that could be triggers for more companies to adopt
Yeah.
some of this. So I think those are interesting. We're also starting to see some early signs of technology stuff that has happened, deep tech, particularly AI. We met a few companies in Saudi, we met a company in Abu Dhabi. We have seen Falcon come out of this region, so maybe that will inspire more people to start and take on these kinds of deeper technology challenges. But honestly, the one thing that needs to be thought through here and fixed more actively is talent supply, right? So to do some of this, you just need depth of engineering talent. And if you don't have the universities here that produce this engineering talent, then you're dependent on people coming from outside. Now, we are doing in this region a great job of bringing people in
Yes.
and,
In the
giving them
UAE.
golden visas in UAE. I think Riyadh is encouraging people to, also come there and so on. But as we do all of this, we also have to think about more longer term. How do we make sure we produce that talent here? Can we kind of create these universities of excellence that can produce, research and produce talent that can go on to become founding members or founding engineers in other companies? I think this is something that we have to think through for the very long term, 20, 30, 50 years, that we want to see this region being an innovator versus just a market. And so I think that is something that for all of us to think through. But I think, look, UAE has done a great job. Riyadh, I'm seeing a lot of people talk about moving to Riyadh and setting up there because they all see the opportunity. And so global talent is starting to come in, which is a great thing. And, I was talking about GITEX and, the number of companies that are present there from all over the world. It's just
Yeah, it's
mind-boggling.
incredible.
The energy and the environment that has gotten created here is actually quite interesting.
Yeah, I think the talent piece is definitely quite a challenge. It's been like that for over a decade now,
Well, yeah,
especially
these are
tech
not easy
talent.
problems. These are going to take time
Yeah,
to solve.
yeah.
Yeah.
I mean, we were at a talk with Tabi recently, and we heard
Hussam?
Hassam, sorry, we're at Hassam say that like his entire tech team is outside of the
Yeah,
region,
so he
right? So
started, with Russia, Ukraine, some of these places,
yeah,
and now they're all based in different parts of Europe
yeah,
and so on. So yeah, he has to look beyond, and most of our companies are looking beyond the domestic region. It's also expensive to build here. UAE is not a cheap country.
yes,
When you bring people here, there's a cost of living that you got to think about, and so on. So building talent here becomes relatively expensive. So yeah, so people have to look. Some people are thinking about Poland. Some people are thinking about some other parts
yes.
of
A lot
Asia
of
and
the
so
a
on.
lot of the big players have outsourced their tech
That's
talent. I
right.
mean, even
That's right.
Kareem, I was sitting with Mudassir, they spoke about basically starting up with with an offshore.
Yeah. So what happens when that happens is that you have people starting up companies because a Kareem happens and this mafia of people that leave Kareem and
Yeah.
start other companies happen. But the kind of companies they'll start will likely be business problem solutions, right? Because as business people, they understand business and they can solve business problems. Oh, can I have a better approach to FP&A and can I solve it something with a corporate card? Can I do can I enable some so that's different from core technology
Yes.
companies, which have to come from engineers solving problems, right? And so if that base is not in the UAE, if it's not in the region, then you're not going to see that kind of company come out that easily. So I think that is the thing that we got to change. And yeah, so hopefully in the next few decades, we can try and solve that.
Yeah, that's a great point. So few more questions on your investment strategy.
Sure.
Has the kind of the VC winter impacted your your pace of investment? I mean, have you been writing checks this year? What is
Yeah.
it like?
Yeah. Look, honestly, it is slower than before. 2021 was abnormally fast. People were raising capital every 6 months. So the amount of investment activity and the opportunity set you're seeing was just quite substantial. Typically, companies move from one series to another every 2 years, 18 to 24 months. And you talk about planning for capital, you think of can you plan for 24 months and then you raise a round and so on. But in 2020, 2021, people were raising rounds every 6 months. So, which meant the pace of activity was just substantially. Even if the number of companies was the same, they were just raising faster. That's changed because companies are sitting with very lofty valuations from 2021. They're probably not going to get that in this market. So some people have just cut burn and said, I'm not coming to the market for some time. And then some that don't have product market fit. So things that would have been easy, capital raises in 2021 have become difficult capital raises now. And so it is somewhat of a funding winter. But like I said, this is like fasting. To me, you fast for better health. I think a little bit less capital will make companies healthier.
Okay. And has your is it the pace or also the check size?
Yeah, check sizes, I would say we have not changed anything from when you think about a fund and a fund's construction, you think of a certain number of investments you would make of a certain ticket size. So we are not actively thinking we want to invest less. But what has happened is the company's ability to absorb has gone down also because what they are thinking about now is saying, look, the environment is such that you're not going to get great valuations. So you're not going to go and raise a large amount of money.
Yes.
You want to raise just enough so you can see through a period and then hope you
Yes.
can come back to the market when the market is better, right? So that's one. Second, I think in 2021, nothing could go wrong in the founders' heads, right? So like they were so ambitious that they want to do 20 things, right? And you want to like say, hey, I have like you're almost looking at a situation where capital is so cheap and infinitely available that you could go and conquer the world, like do many things. Now people are much more focused because they're trying to get their economics right. They're trying to get to break even faster. So the number of opportunities they're pursuing is also smaller. So even for them, there's no use for 100, 200 million when you can, build your business to 50 million. So I think those things of conversations have also changed. But I would say largely because valuations are not going to be exciting. Companies will just cut back how much they're raising today.
But isn't that like also the isn't aren't the VCs the culprits in that?
Well, both are like I don't think we should shy away from saying yeah we also were drinking the Kool-Aid as an
Yeah.
ecosystem,
I mean,
but
valuations are going up and up and up. It looks
yeah,
good.
so the challenge is the following, right? Look, and I've seen a few cycles myself, and then every time you look back, saying, why didn't you do something different? The only thing I personally may have done different is to exit a little bit more than I invested, right? So you understand the markets are hot, so can you get a few companies out? Now that is not to say because they can get the best price. It's also because some of your okay but not great companies you can only exit in the markets like this, right? So people underestimate how hard it is to exit companies, right? The very best companies is always going to be demand. What about the not very best companies, right? Either they have to become sustainable businesses and go public because the public markets can absorb companies of different shapes. Valuation may be different, but you at least have a way out. But if you're not a good quality company, then there are no buyers in the private market. Nobody wants to come buy your stuff. So in a bullish market, you want to actually exit a few positions that you can because it won't be possible, right? So that maybe is one difference, but it is very hard to remain completely inactive in a market because while there's a lot of froth, some of the better companies are still getting built in that time, right? So are you going to just stay out and say, good or bad, I will not touch anything because valuations are crazy? Most often that's not realistic. And 2021 is still early to know whether we did well or not on an aggregate because you will have good investments and you'll have some bad investments, and so you'll have to look at it as a portfolio. But if we look at the 2015 vintage in India, when there was also a little bit of a bullish market, some of our better investments happened in that period,
Okay.
right? And so the very best companies, subject to you not paying a price that is billions of dollars, right? But you may have still paid a high price at the hundreds of millions of dollars, could still positively surprise you because they can get to a 10 billion valuation or 20 billion valuation. The problem is if you got both the pricing wrong and the quality of business wrong, then there is no escape, right? And yes, we would have made some of those mistakes as well. But by and large, we kept the bar high on the quality of companies we're looking at. So yeah, there's a little bit of pain on having paid a price, but if the quality of companies is good, hopefully they grow into the price and beyond as they come out of this downturn, right? So to me, are VCs responsible? I think in general, capital was so cheap, right? Founders realized that capital was cheap, so they were going aggressive. Capital was cheap somewhat for VCs as well, so even they may be going aggressive. And our business is about the power law. You got to be in the winners, and it's very hard to know at the time of investment which company is the power law company. So you don't want to miss something that has momentum. So yes, some mistakes were made, but I wouldn't. I mean, I think it's a little bit early. I think the vintage will be overall not a great vintage because you paid high prices, but there'll be a difference in how funds have done even within that based on the quality of what they picked. I think that hopefully differentiates the people that have done a better job and not.
Okay, so let's talk a bit about, I mean, your area of expertise. I mean, you invest in growth stage companies, so you're coming in, you're writing that bigger check. So at that stage, there should be less mistakes, right? Than in the early
That's the
than
hope.
in the early stage,
That's the hope.
because I mean, you have there are a
Yeah,
lot
you
of
have much less data, so you don't have a way to see it. Yeah,
yeah, but
yeah.
at your stage, you have more
Yeah, you
data.
have more data for sure.
So,
Yeah.
so what do you, I mean, what do you look for in these companies when you
Yeah.
decide to invest in the companies? What are some of the, let's say, I was on a podcast recently with someone who has a book called Red Flags, Green Flags,
That's
So,
interesting.
so
Okay.
what are some of the, red
Yeah.
flags and green flags
Yeah.
that you see
Yeah.
at that level?
Yeah. I think at the level we invest in, which is a growth stage, some of the red flags. Look, first,
Sorry, just to
yeah,
clarify, growth stage, I mean, you're writing a big check. The
yeah,
company is valued at probably 100 million
yeah,
or so.
something north of 100 million. Yeah.
Yeah,
So sweet
yeah,
spot maybe 100 to 200, right? And then,
yeah.
in 2021, that number may have gone up to 3, 400 because the market's inflated. But usually we're investing in the 100 to 300 and then looking to see whether we can make a 5 to 10x return from that space. So we are looking to see companies become 2 billion, 3 billion, and so on. So that itself is a metric in a way. Can you see a path to a couple of $1 billion or beyond, right? Because we won't make our target returns if the companies can't get there, which is a function of the main thing being market size. Right? So you come back to saying, hey, is this a market that is large enough that will allow you to build a $2-3 billion company, which depending on which sector you are, maybe 300 to 500 million of revenues that you need to get to. So that's the main question. So if the market itself is $1 billion market, yeah, it's very hard to get to a 500 million revenue in $1 billion market. You could in some markets, but not in all. So you kind of look at market size as one of the main metrics. The second thing I'd say is, it basically for us always boils down to market and founder, right? In any form.
Market and?
Founder.
Okay.
Then
Even at that level?
Even at that level, founders are important because very rarely do we intersect companies in Series B and Series C's where the founders step back and there's a CEO in the business. There's always a founder. The founder is still driving the show. And for many companies, up until they go public, most likely founders are driving the show. And so it's very, very important to calibrate for the founder and the quality of the founder and how they are. And there, it's a little bit more art than science, but as you have these conversations with them, you try and understand who they are as people, right? Because you want to see that these are gritty people because times are going to be tough. It's not going to be an easy walk in the park. So you want to see people that have been there, done that, gone through some, pain, because from that pain, they would have grown, right? And so if you have this mindset of growth, a growth mindset, and you say, hey, I went through trouble, from that I learned something, those are typically better situations. So if I meet somebody who's been always successful, usually I'm worried about that because I don't know how they're going to behave when things are not going well.
I think that's
right?
hard to find.
Yeah.
In
Well, it's hard to find, but I've had that experience. I've had a couple of
Okay.
situations where founders have had a very good life in the sense that they've been successful in what they do and they've not had to face a serious level of difficulty, and which means they've not had the journey of self-discovery, if you will, right? And building that grit, seeing that okay, times are bad, but I can get through this, and I've come to the other side. And so people who have gone through those journeys are fundamentally much stronger, and they're going to not be worried when things are not going well. They know they got to dig in and fix things, and they'll be willing to roll up their sleeves and do that. I think that's something that's important to see. Second thing is just how they think about life, their life experiences, what they've done, the choices they made, why they made those choices, some of their value systems. I think these are all softer things, but you pick up when you talk to them and how they think about life. I think that this, I'd say, like some benefit of having done this long. And I'm not going to say that we get everything right. We sometimes get it wrong because people have also learned how to become better storytellers. Right?
Yes, of course.
So, while we are trying to hone our skill, they are
There's a
honing
lot
their
of those
skill as
around.
well. Yeah, so people are good. Sometimes people are very good storytellers, and you cannot, today everybody would start by saying, I'm solving a problem that I faced, right? Like, how many of them have truly faced that problem? Everybody knows, but that's good to say because that makes a great story. If you say, hey, I grew up like this and I faced this problem, I started this company, I couldn't get a corporate card. Now I'm going to go build, the Brex for this region, but there are 8 people doing that, so the question is, like, did you fundamentally come from that place, or you said, hey, I'm an ex-consultant, I look at global markets, which business work there, can I bring that business here? Many people start that way. I don't think there's a value judgment on either of this. There have been very successful people who have brought models to a new region as well. But it's hard to know from the stories that people tell what it is. But if you do find somebody who is very authentic about why they started what they started, the reason it goes back to the same conversation on grit. The people that start these businesses are actually, very capable people, right? For the most part, they have high opportunity costs. So at the time when things are not going well, right? Are you going to sit there and think, I was a McKinsey consultant. If I had been in my job by now, I'd be a partner, and this is what I'll be making. Here I am, like it's not going well. And if you're going to give up because your opportunity cost is so high, and you will give up if you're not authentic in terms of the problem that you're solving and how it speaks to you, right? And so we worry about some of that. And so the best founders have some way to identify that the problem, they really care about the problem they're solving and have a way to identify themselves with the problem. And that is good, not a necessity though, right? But my point is, look, we get it wrong sometimes because people also tell good stories, and then not every founder transitions to being a great CEO, and that itself is a journey that people learn over a period of time, and sometimes you learn only through making several mistakes, and there is a cost to that.
But at that point, GV, I mean, it's interesting that you're talking so much about the founder, because again, at that point, it's a $100 million plus dollar company. They've probably been running for 3, 4, I don't know, maybe 5 years. So it's interesting that it's so important,
Yeah.
even though you have more tangible things as well, right? Like you have their growth trajectory, you have their unit economics.
Right. So look, I think those are part of I mean, very, very strongly part of the mix in terms of our how we diligence a company. We need to see unit economics pan out. We need to see growth trajectories. We need to see a path to profitability overall, etc. But I think it's very hard to take the founder from the equation. We don't come in thinking the founder is replaceable, right? Theoretically, they are, but practically, we're really backing this guy or this girl to go do this that we have signed up to do. And so to when we are doing growth investing, we are also trying to minimize the number of variables that could go wrong, right? And one of it is the team. And this almost the most important thing because we can't assume that it's replaceable easily. In the US, it's probably slightly different. Even there, I think, if you talk to Sequoia in the US, founders, very, very important piece of the puzzle. But in that ecosystem, there's a board which can, fire people, change people. It happens more often than what we see in our geographies because here it's all about the founder and behind the founder. And we don't have an ecosystem that's so well developed that you have hundreds of professionals lining up to take up a startup job. Still this whole do I need to do a startup, there is risk kind of mentality for the large part. And so it's not easy to find these been there, done that 3 times who you can bring in to run a company, which happens routinely in the US. So for us, it's very important to get the founder right. And there is something about founders' energy that is not easy to replace, right? A CEO is probably really good at running a business, but their ability to take the kind of risk that a founder is willing to take, generally is not always the same, right? Because they're trying to, I keep thinking about what's the difference between founders and managers, or I wouldn't say CEOs, but managers, right? Like, I think founders think about what if things go right. And then a lot of managers think about what if it goes wrong because they're worried about their jobs, right? So I think there's a huge difference when you think about what can go right and you get it right, you have a big outcome.
I think the founder is also so important. I mean, I was a founder myself. I sit with a lot of founders here on the podcast, and it's not only it's their ability to give people meaning and purpose. I know it sounds very cliche
No,
and
it's
some
not.
people would
It's
laugh
not.
at that.
If people
But it
live by
is. I
that,
mean, the fact that like Mudassir is still there running the show, and sorry, and
exactly.
Magnus and Abdullah,
Yeah, yeah,
like they're still there. They're running
yeah,
the show.
yeah.
I mean, that's a
Yeah,
big.
100%. I think there are many stories where, the most popular Steve Jobs story when he's brought back to Apple and so on, right? And there is something about the founder's energy, right? And which you're right, rallies people around
Yeah, and if
because they know it's a piece of that person in the company or it's kind of not fully detachable from the
yeah.
situation, right? And that's the kind of intermingling of the soul of the company and the founders is probably an important dynamic for a lot of people because there's a sense of belief that comes from a founder saying we are going to go do this and and they are all in, right? If it's a manager and a CEO, there's always another job they can
Yes.
take, right?
Yeah.
So you always wonder if they're all in. And I think founders are all in, and that's the kind of people you want.
And I think you can get away with asking more from people, by the way, if
Oh,
you're
for
a
sure,
founder,
for sure.
than if you're like a hired gun,
Yeah,
basically.
yeah.
What about the ability? I mean, you touched on something earlier, which I thought was very interesting. Like, how much money will this company need to raise before you can see some form of exit?
Yeah.
So, is this part of the equation as well?
Um, when it comes to growth investing,
Yes. So you're putting in that $20 million check, and then you think, okay, this company to get to a $10 billion company or $5 billion
yeah.
company. Uh, would you consider, okay, they may need to raise another
Oh, for sure.
half 500 million
Yeah,
or,
we need to think about what's the downstream dilution because
yeah.
that hurts our returns if it's too much, right? And so, which brings us back to saying, are the economics strong enough? Is it going to converge? Are they going to become profitable soon and so on, right? So, when we're investing in the growth stage, we are looking to see if in a time-bound manner there is a path to profitability, typically 18, 24 months. You don't want to see like a 5 years. I have no idea how they're going to get profitable because then you're signing up to say there's going to be lots of rounds and dilution coming up, and you got to model that in your thinking on how you make returns. Uh, and if you talk about regions like this where downstream capital is not that easy, then it adds risk to your investment because what if they cannot raise it
Yeah.
or cannot raise it at the prices that you want because there are very few options, right? So I think it's an important thing to think about saying,
Yeah.
is it funded to profitability? But honestly, look, having done this long, like most founders will go and raise if it's available, and it's hard to because at some level sometimes founders expand their ambition based on capital availability. That's the truth. They
Yeah.
will do one more thing. If there's easy capital available, they'll say, okay, fine, why don't I launch this as well? And then, go for it and so on. So um, few people can remain straight and narrow on what their core thing is, and then just be there doing that over and over again, because it can get boring, and then you have to be comfortable with things being boring if you want to build an enduring business. But then the exciting stuff is to launch new things. So founders by nature are creative people, so they want to launch something new and exciting. So, and hence there is a time when a founder should step away to hand it over to a CEO who's willing to do the boring and normal stuff and be in the straight and narrow and keep just doing the same thing over and over again and grow 30% year on year and deliver maybe 40% earnings growth or whatever and deliver a public company. That is not for every founder. Sometimes a founder may say, that's not what I signed up for. I want to do the 0 to 1. I want to keep things exciting, right? And so this understanding of what is a good time to say, hey, let me bring somebody to do the more boring stuff, right? But is important nevertheless, is a thing that not everybody is able to naturally do. But that's the role of the board and kind of trying to guide the founder to say, hey, this is a good time for you to put somebody in this business. Why don't you become, take the 0 to 1 or something else we are launching or something like that. So that's something that we encourage people to think about.
You said many things that I want to pick on. I mean, so you said also like path to profitability is something important. I mean, now in current times, especially in this part of the world, path to profitability is even being looked at in very, very early stages. But then you also said that these are markets here. For example, it's a market where you can have one or two or maybe three players, right? Because the market is not that big, so you can have whatever 5-10 players competing on the business.
Yeah.
So how do you balance that, right? Like how do you balance
How do you balance going for it versus kind of getting profitable?
growth versus profitability? Because if
Yeah.
you want to be profitable, it's gonna first you need to raise more money. You will burn more money. You have to do it much faster.
Yeah. I think the way I think about growth is there's good growth and bad growth. Good growth is when it's coming largely organically, coming because customers are extremely happy with what you're doing. And, if you see the nature is that you found product market fit at healthy levels of unit economics, right? So look, the easiest things to do is buy something at 100 and sell it at 90. I mean, of course, infinite product market fit, right? And you can grow as much as you want. The truth is that's not product market fit. So the question is, can you have product market fit at acceptable and good economics for the business? If you establish that, and then you're able to grow with that economic shape of the business, that growth is good quality growth. The moment you say, hey, I'm just growing because I need to grow, and it doesn't matter, it can come from deep discounting, offers, whatever that you're doing, with poor economics, that's bad quality. That's like burning, just simply take the cash and burn it, because that's really what you're doing. And, you're not going to get the loyalty of the customer just by throwing something cheap at them, right? You want to be everyday low price like an Amazon or a Walmart does, which is, you kind of establish this notion that you get value on this platform. And that's different from being the cheapest. So I think important thing is the quality of growth you get, right? And are you getting that at good economics? The other thing is when you think about growth and profitability, supposing you are a ride-hailing business or a business that's kind of launching geography after geography, are your old geographies reasonably profitable? And if the burn is coming from the fact that you're growing in new geographies, that's acceptable, right? The problem is everything is burning and you're just growing because, again, you're discounting it or you don't really have PMF at the economic shape that you need to have a sustainable business, then that's poor growth again. So when it comes to growth and profitability, I kind of think of it as, look, can we think about what is good quality growth? Can we think about growth and profitability in the regions that you're operating for a long period of time? For a retail business, what about your 2-year-old stores, 3-year-old stores? Are they profitable? You cannot have everything burning, right? So you can justify new expansion, new product lines, things that you do, but it's hard to justify an old business that's not making money. So I think those are nuances that you want to balance. So my answer is, like, it's not like, a 3-year-old company has to be profitable and just sacrifice growth. If they have a lot of room for growing, they should grow, but make sure that where you're investing is justified in a way, right? And then you are at a point where you can switch back to profitability if things go wrong, right? And there will be markets like this where you may have to, in the short term, survive before you can thrive. And can you survive? And at those times when you change your discounting or whatever you're doing and you find that the market vanished or your demand dropped 80%, then you never had real PMF. And that's the danger, right? Like, momentum is very tempting, but we got to look under the hood to see, is it higher quality or not?
Because a lot of, great companies were unprofitable for a very long time.
Sure.
But I think it's a notion that's very hard to stomach in this part of the world. I think I think what is happening globally is very much received here because it was always, I feel like it was
It's an
always
open market. Yeah, it's like a
it was
connected
always what they
market.
wanted anyway,
Yeah,
like
yeah,
focus on profitability early on, etc.
yeah.
Um,
And that said, I feel like, look, as I see businesses around, there is also the effect of the Western world is also true in how people were building businesses here, right? So people were actually burning a lot of money when capital was available relatively easily, and so you know you want to, if you can't selectively take the lessons, if the market tells you now that look, there is no capital, yeah, then you got to buckle up and figure out how to get to a state where you can be more efficient. And so it's not easy to do, particularly if you're a first time founder and you've not seen these things. It can be quite challenging, but look, in a way that's what you signed up for. Like, you got to go through this journey.
What are your views on valuations? I was listening to a podcast this morning. They were talking about like the US IPO market and how a lot of companies that IPO'd recently, a lot of the tech companies have seen their value go down 90%, 95%, 70%. And so one of the reasons, that was given is that a lot of these VCs are using basically the IPO market just to kind of like dump the bad investments, basically. I think it seems that the private valuations are much higher than the public valuations.
Sure.
So what are your views on
Yeah, look, this is a very geographic centric and sector specific answer. And I think what we are seeing in Indian domestic markets is valuations are actually, like in the private markets, not yet corrected for growth companies significantly. And the reason for that is, one, we have not had, serious number of companies coming back to raise yet. It's been a couple of years since they raised their rounds, and most of them raised a large amount of money in 2021, which were way beyond what they may have needed immediately. And then,
okay, which was a
and
smart thing to do
which
in
was a
hindsight?
smart thing to do because capital was cheap, right? So
Yeah.
dilution was less. So for the same dilution, you can get more capital. And look, no blaming on founders. If it's available, they'll take it.
Yeah.
It's the thing to do from their perspective. It's a survival. Just making sure, like, why would you let your competitor have a lot more capital and you don't have it? The question is, what do you do with the capital? There's some that manage to keep it, some that burn through it. Now that's where there's a difference between, like, whether it was a smart decision or you were just going with the flow. And so the people that have managed to keep the capital, or they also then don't have to come into this market, right? So what we've seen is that because a lot of messaging quickly became in 2022 about cutting burn, extending your runway, and so on, a lot of companies, at least in India, have not really come back to the market yet. And we were hoping that around this time you will start seeing it. Now it feels like it'll probably happen in 2024. We're starting to see some improved flow, but it's not yet at a stage where people have just come back at all, right? So
Come back to
come
fundraise.
back to fundraise.
Yeah.
And so if they don't come back to fundraise, then there is no change in valuation because they're not in the market. Yeah, but there are some secondaries happening in some companies. Those are happening at discounts, and which is understandable. Primaries we've not seen, unlike the US, where for ESOP reasons, etc., people have actually marked themselves down significantly. Klarna did it, Instacart did it, and so
What
on
do
and
you
so
mean
forth.
for ESOP reasons?
So you cannot attract new talent if you're sitting at 50 billion valuation and the markets have corrected so much. The incoming engineer is going to say, "Hey, I have no money to make here." Right? If
Okay.
I'm going to get shares at 50 billion and it's not the right price, everybody knows it because the markets are corrected, but your last round was 50, your ESOP is probably pegged to that round. And then if I joined you as an engineer today at 50 billion, my real value is probably 10 or 15 or 20. I know I'm underwater day one, right? Like, why would I join? So people won't join. So, or you will even lose people who are here who got at higher valuations and now the valuations are not there anymore. So a lot of people mark their valuations down so
Interesting.
that they can issue shares at lower prices to attract or keep talent. And that kind of stuff has not happened in our regions, right? So, maybe because that culture is not there. And so until you see some of the significant pricing changes, the market doesn't really open up, right? And so valuations have remained high. And, I was talking to a banker yesterday in India, and, he was making the same point, saying, look, we are not seeing yet, but it will happen. It's a matter of time. You can't hold back for a very long time. So, but that said, look, public markets in the US for, let's say, SaaS companies is probably trading cheaper than where private market valuations are held, and that's the truth. So a lot of the crossover funds who are very active in the private markets in 2020, 2021 have all gone back saying there's more value in the public markets than investing in private. So that's one of the things we see. One of the reasons why growth capital is in less supply is because people are seeing better value in the public markets. It's not that true in India, where public markets continue to thrive and do really well. So we have not seen a human. I mean, there's some correction on some technology stocks, but it's not a whole lot. So it's very different depending on the geography. And to me, hence the question is, look, today if you had to invest in AI, you're still facing a valuation challenge. So it depends on the sector and the geography as you think about valuations.
Okay. So what about exits? I mean, what do you look for when you're investing in
Yeah,
India
yeah.
and you're investing in MENA? Where do you
Um,
see the exits coming from?
I think these regions have never been strong M&A markets, right? So the first question we ask is there a path for this company to be an independent company? And when I say independent company, that they can be publicly listed and trading and, have a path to being an enduring company, which comes from a few things. You should have a large enough market you can continue to build for a long period of time. You should have good economics so that a public, market analyst or an investor would say, hey, there is good return on capital in this business that I can, own it, and there is growth, which is the point around market size and so on. So I think so when it comes down to that, so for most companies, we ask the question saying, can this be a public company? Because that's the only thing that somewhat we control if we perform well, right? The M&A action, we don't control who's going to come into the market, who's going to pay a price, etc. I mean, it's much more common in the US and so on, but it's not that common in our parts of the world. So I would say, hence, it goes back to saying, can you build a sustainable large business that can grow for many years? And that's what we look for. And in India, at least, hence, India public markets is our default option. India public markets, interestingly, we have almost 6,000 plus companies listed. So it's a large
Wow.
market, very, very liquid if you have the market cap, very illiquid if you are a small cap. But you can at least take a company public, right? So that's definitely one of the ways it happens. In this market, I think there've been one or two examples of tech IPOs, particularly in Saudi. Hopefully there will be more, and at least I'm kind of hoping that the things we have seen in India, similar behavior can happen here, whether it's in the Saudi exchanges or in Abu Dhabi, and now they're talking about dual listings and so on. So it's very interesting. I think the investments behind creating a vibrant domestic public market is integral to having a thriving private investing ecosystem because we've left to see exits. And it's not always you're going to see the Amazon Souk or the Uber Kareem type
Yeah.
examples. And so we can't bank on that as a possible
Yeah.
exit option. So we should have a thriving domestic market to take our companies
Yeah, I mean,
public.
you also often hear, right? Like sometimes the company can be too big to be acquired
That's
unless
true.
there's like an Uber coming
Yeah,
to
exactly.
pay
Right. If
three
you want to
billion
have a
dollars.
$1 billion exit, you need to have at least a 10, $20 billion acquirer. And
Yeah,
so that limits the number of time
yeah.
things, people that can do it. So, but the public markets can absorb large companies. And
A-
so that
And
becomes naturally.
listing outside the region seems to be not a good idea.
Not qualified to talk about it, and I've not seen enough examples. What I've found is Indian companies tried to do that. A lot of them, at least all the YC-backed companies, had this notion that they would be headquartered outside and list in the US. But then you see the US markets. Look, if you're a $5 billion company, you're still a small cap. And not many people are going to give you attention. So that's challenging. We
Yeah,
we would celebrate a $5 billion exit in this part of the world, and if that's not significant in the US, then why go there? I mean, maybe you can,
yeah,
uh, as long as there is an opportunity to list here, then maybe that is interesting. And also, we have found in India, technology stocks are not in wide supply, which means if you are well performing technology company, you probably get a premium in the domestic markets compared to in the US. I mean, in the US, there'd probably be I don't know how many dozens of SaaS startups are already listed. I mean, you would have zero in India, and so if you were the first few SaaS startups in India, maybe you get a premium, right? So those are things that matter as well as you think about how you think about liquidity for these companies.
okay. I'll just ask you one last question. I know I've taken quite a bit of your time.
No worries.
What is some of the advice that you're currently giving your founders in your
Yeah.
portfolio companies?
Look, this is an interesting time because you're not going to have very many well-funded competitors, right? So if you can double down on investing in your product and making sure that you come out of this with a substantial lead, then you probably taken the edge and kind of taken a lead in the market in the way you are. So what that also means is you have to make your dollars count, right? Like you can't kind of piss it off, for a lack of a better word. So just make sure that you're investing in the right places. Don't have the burn like that you don't need to have. Especially don't have the wrong kind of growth, which is don't create. Not every market is a winner take all market, and I think this people get wrong many times because everybody thinks, oh, let's blitz scale and do this and do that. But there are few businesses that have this network effect that really make sure that the winners win big. For most other things, you're fine, building a higher quality business and not trying to win high market share, because that's not realistic. And in the process of trying to do that, you would kind of burn through a lot. So at least my advice is, look, try and kind of do sensible things, invest in the right areas, extend your dollars and come out of this downturn stronger, because I think there's going to be the people that come out of it stronger, and this goes back to something I wrote about kintsugi and the kind of the art of the broken pottery in Japan that you put back together using gold dust. And I think you're going to see these things become more valuable and beautiful because they've gone through this process and gone through some of the struggles and come out stronger. I think it's a great place to be. And so yeah, if you can use this downturn to your benefit to kind of strengthen yourselves, to cut out the flab, invest in the right set of things, and build a much more enduring and economically stable and attractive business. I think there's going to be many more takers down the road for people like these. So I think that's the advice to founders.
What's your prediction in terms of how long this downturn going to last?
I'm sure I'm going to be wrong about this. We thought second half of 2023 life will get better, and there was some signs because the Nasdaq went up in the first half, but just so much uncertainty all across.
I mean, I'm hearing 2026.
Oh wow. Okay. Who knows? Look, I think we should be aware of the macro, but I don't think we can kind of build with that in mind. We have to build from fundamentals. We should just do the right things. I think there's while things could take longer, there's still a lot of investors who have to invest capital. That's their business. They got to do their work, right? So the question is, how can you be in the top 10% of companies? Can you be in the top 10% of companies which have high chance of getting attention from investors and getting the capital? I think as long as you work towards that, you would be fine. Yeah, macro is important, but that shouldn't limit, and that shouldn't be the reason why you don't make it. You should build a very high quality business, and within the set of options, stand out.
Okay. Thank you so much for your
Thank
insights.
you, Loulou. Pleasure
It's great to have
talking to you. Thank you for having me.
Thank you so much for tuning into this episode of Conversations with Loulou with GV. I really hope you found it insightful. As usual, check out conversationswithloulou.com to listen to all the other episodes. And don't forget to subscribe wherever you listen to or you watch the show to get notified when the latest episode drops. Do give us a rating and a review. It really helps in getting the show discovered. And don't forget to share with friends, family, relatives, and whoever you think would benefit from this content. One more thing, there is a link to the podcast listener survey in the show notes. I would really appreciate if you spend 7 minutes of your time to fill it up. It would really help me and get to know you a little bit better. Thank you so much for tuning in, and see you in a few weeks.